Okay, so hello everyone. I welcome you in the second lecture of Cambridge AS and A level accounting. Okay, so before starting the subject, I planned that those students who are referring this subject for the very first time, they will understand the basic terms of accounting. So it is not related to any particular topic from the book. We are just going to discuss basic terms of accounting. Okay, so without much ado, let's start with the lecture, and let me share my screen first. So this is the topic of the day: basic accounting terms. Okay, so first accounting term is the main subject, the word accounting. What does it mean, accounting? See, in any kind of business, everyone wants to know how much profits and losses they have earned. Okay, and without knowing this fact, uh, it's really very difficult to carry on the business. You can't predict your future, you can't plan your future. And to calculate this thing, you need to record your financial transactions. Okay, so it is a kind of process, okay, in which you need to record your financial transactions so that you can get the results. So if I'll summarize this particular definition, accounting is the process of recording, classifying, analyzing, and communicating financial information. So you need to analyze all the financial information, whatever you are doing, all the financial transactions, whatever you are doing. So it is a kind of process. In other words, accounting is a process. See, it is a kind of process. Process is what? When you will do one step, one after another. Step one, then step two, and then step three. Okay, so it is a process. In you have to follow all the steps in a particular sequence, right? And what are those steps? Accounting is a process of identifying. First, you need to identify the financial transactions. What kind of financial transaction you have done, which has a monetary impact on your financial condition, right? Identifying, then measuring. Then you need to measure. See, uh, I have paid some money to my friend. Huh? But how much money you have paid? You need to measure in terms of money. So measuring. Third step is recording. Then you will start recording. Okay. And then classifying. There will be multiple transactions you will do in a particular year. So you need to classify all the transactions so that you can get information about a particular person, whatever transactions you have done. So you need to classify. Then summarizing. You need to summarize all the information. Interpreting. Then you will interpret at the end how much profits and losses you have got during the year. Okay. And finally, communicating. The financial position with the users of financial statement. So after recording, classifying, summarizing, and once you will get to know that this much of profit we have earned during the year, that is our financial position. These are the assets and liabilities we have. What does it mean, assets and liabilities? We will discuss in today's class only. So all the information you will get from recording the financial transactions into your books of accounts, you need to share, you need to communicate those information with the users of financial statements so that they can take managerial decisions, they can take any kind of decision for future. Okay, so that is our first definition, that is accounting, and this is your subject, accounting. Okay, now moving ahead, next term is financial transaction. What does it mean? See, financial transaction, if I'll tell you in a layman language, in any kind of business, you will do buy and sell, these kind of trading activities. So any activity, any event which is happening due to which your financial condition have a positive or negative impact. Simple as that. Okay. So if you, just an example, if you will pay $100 to your supplier, so by $100, your cash balance in your pocket will get decreased. So it will have a monetary impact on your financial condition. That is called financial transaction in all. So let's write this out. It is a business event. It is a business event or action that has monetary impact on the business. On the business. Now, next point is types of financial transaction. So there are two types of financial transactions. Number one is cash transaction. First, let's understand cash transaction. What does it mean? In which you have to pay or receive cash, money immediately on happening of the event. Okay, so you are getting money or paying money immediately. Huh? So cash transaction in which the business will receive or pay money immediately on happening of an event. Simple. And number two is credit transaction. What does it mean, credit transaction? Credit transaction means in which you will receive or pay money after some time, after some credit period. Huh? So you are not going to receive money immediately. You are not going to pay money immediately on happening of the event. You will pay or receive money after some time, after few days. For example, after 10 days of credit period, right? Which is being provided by the supplier or which is being provided by you to your customers, right? So write this out also, credit transaction in which the business will not receive money receive or pay money immediately on happening of an event. All right. I hope these three definitions will be clear to all. Now, moving ahead. Next is capital. What does it mean? Capital. See, every businessman, whenever they want to start their business, they have to invest some money or they have to buy something for starting the business, like building. They have to buy some furniture, they have to buy some stock so that they can start their business. Okay, which we can say initial investment of the businessman. That is called capital. And in normal due course of the business, to carry out all the financial activities, we need money, and which is being invested by the businessman into his business. Again, it is called capital. So any money or thing invested by the businessman or we can say by the owner into his business is called capital. Okay, so that is another definition which you need to know before starting the subject. Moving ahead, drawings. Next term is drawings. Drawings is what? When the businessman, the owner of the business, is withdrawing something from the business for his personal reasons, for his personal usage. That is called what? Drawings. Write this out. Anything withdrawn by the businessman or you can say the owner of the business from his business for his personal usage, then it is called drawings. Please understand one thing. When the person is withdrawing anything for his personal usage, so do remember this thing, personal usage. It is very important thing. If the businessman is withdrawing something not for the personal usage, for the business purpose, so it will not be considered as drawings. So you have to keep this in your mind. Okay. Now moving ahead to the next definition. Next is liabilities. Liabilities, simple. Liabilities are the responsibilities of the business towards the other people. Means these are the things in which you need to pay some money to the other people, who are associated with the business. Okay, so these are the responsibilities you have. So we can write the responsibilities of the business towards the other people. In other words, we can write any money payable by the business to others are called liabilities. All right. Next point is types of liabilities. So there are two types of liabilities. Okay. So number one is non-current liabilities. Which are payable within the period of 12 months. sorry, non-current liabilities which are payable beyond the period of 12 months. Like you are taking bank loan which is payable for next 10 years, within next 10 years. So it will be paid every month in installment, and for the next 10 years you will be liable for that. That is called non-current liabilities. Okay, which is payable beyond 12 months. Next is current liabilities, the opposite one, in which these liabilities are payable within the period of 12 months. So any liability which are payable within 12 months, that is called current liability. Just an example, you will buy some goods, some products of your business from any person, any organization on credit. Means you will pay after some time. So your supplier will not give you the credit period of more than 12 months. You have to pay the money within the period of 12 months. And it will be categorized as current liabilities, your creditors, right? Your trade payables. Next, assets. Next is assets. So these are the property of the business, properties, whatever properties you have, your business have, that is called assets in layman language. Like your building, your office, it is your asset. Your furniture in the office, it is your asset. If you are carrying on manufacturing business, so all the machineries there for manufacturing purposes are called assets. So these are the example of assets. So we can write this like assets represents anything owed by or owing to the business. These are the properties of the business. All right. Next is types of assets. Again, there are two types. Non-current assets these are the assets which you will not buy for resale purpose. Okay, you will use it. These are the resources of yours. Okay, you will use it for a longer period of time. So non-current assets are not purchased for resale purposes. The business will use it for the business for more than 12 months. If you want to write some examples of it, like building, furniture, machinery, etc. Next, current assets. Now, these are the assets which are convertible into cash within 12 months. The opposite of non-current assets, which are bought for resale purposes. Okay, so current assets are bought for resale purpose. It can be converted into cash within the period of 12 months. If you want to write some examples, like your trade receivables, cash in hand, etc. I hope this definition is also clear for non-current assets and current assets. Moving ahead. Next term is receipt. See, whenever you will buy something, you pay money to the vendor and he will give you a acknowledgement, a document in which he will mention that he has received this much of money from you. It is a documentary evidence for anyone, which says that the respective amount which is mentioned in the document is being paid by you or received by you. Okay, that is called receipt. So we can write like, it is a written acknowledgement of money received and acts as proof of payment. One more example of receipt is when you will deposit some money in your bank account. So the banker, the cashier of the bank, will give you a particular slip in which it is mentioned that he has received this much of money from you. Okay, with the seal of the bank, his signature, date, everything will be mentioned. So it is a proof for you. Okay, so you can produce that particular slip in any court of law for settling any kind of dispute related to that particular transaction, right? So receipt. Next, types of receipt. So there are two types of receipt. Number one is capital receipt. These kind of receipts are those which you will not receive in normal due course of business. Okay, by doing normal trading activities, the business activities, whatever you are doing, these receipts you will receive whenever you will sell some kind of capital asset, some kind of, you can say, non-current asset as well. Okay, so you can write like capital receipts will not be received due to normal business activities. Whenever any non-current asset is sold, the consideration received against it is called capital receipt. Another type of receipt is revenue receipt. These are the receivings which you will receive due to normal business activities, buy and sell. Okay, just an example, you are carrying on a business of garment items. You do have a showroom of garment items, and you are selling those items and receiving money. It is called revenue receipt. But in the same showroom, if you have some kind of furniture and you are selling it, you are receiving money, that is called capital receipt. Furniture is a non-current asset. I hope you understand. So revenue receipts are those which are received due to normal oblique trading activities. All right. So these are the types of receipts. Moving ahead, expenses. Expenses. I hope you know by the name any kind of spending, due to which your profit will get decreased is called what? Expenses. Okay. So any amount spent during the year for the purpose of business is called expense. All right. Moving ahead, purchase. The term purchase whenever you will buy such thing for which you are doing the business. Just in my previous example, you are carrying on a garment showroom. If you will buy any garment item for resale purpose, that is called what? Purchase. So we will write like any product of the business bought for resale purpose is called purchases. So these are the few basic accounting terms we have discussed. Now moving ahead, another term, purchases return. Now, such bought product, if you are returning to your supplier due to any reason, maybe there is a defect in the product and you are returning it to the supplier, that will be called purchases return. So the goods purchased earlier is returned due to any reason to the supplier is called purchase return. Or another term is return outward. Next term is obviously sales. Sales, the opposite of purchases. If you are selling your products, your goods to the customer, which you have bought from any other supplier, you're selling it now, that is called sales. Okay, so the goods of the business sold by the businessman to his supplier, to his customer, sorry, is called sales collectively, right? And next term is sales return. Now, such goods which you have sold to your customer, and your customer is returning it to you due to any reason, maybe there is a defect in the goods, then it is called sales return. Such sold goods if it is returning back to the business due to any reason, then it is called sales return, or return inward. That is another name, because goods will come in, that is why return inward. I hope this term is also clear to everybody. Now, next term is inventory, or you can say stock. This is what? The unsold goods of yours. The unsold product lying in your shop, lying in your godown, which you will sell in future. That is called inventory. Unsold goods lying in shop or godown is called inventory. Or you can say stock. Again and again, I am using one term, that is goods. What does it mean? The product of the business. Like in garment shop, what will be the goods? The product. Product is what? The garment item which you are selling into the market. So goods are nothing but the product of the business. For which are bought for resale purposes. Simple. Goods. Next term is trade receivables. I have used this term when I was discussing current assets. Okay, what does it mean? You can see with the name receivables. These are the people from whom you will receive the money. For example, you have sold some goods on credit. So your customer will pay you the money after some time. So your customer will be considered as trade receivable. Write this out also. These are the people from whom the business will receive the money. And another term is trade payables. What does it mean? The opposite one, non-current liabilities. These are the people to whom the business is payable. Business is liable to pay the money. So these are those people, right? Just an example, you have bought some goods on credit. So to your supplier, your business is liable to pay. Business is responsible to pay. That is called trade payables. Your supplier will be called as trade payable. So we can write like, these are the people to whom business is liable to pay money. Simple. All right. Next term. Books of prime entry. These are the books in which you will record your financial transaction primarily for the first time before recording it into ledger. Simple. So you can write, these are the books in which transactions are recorded before being entered in ledger. And finally, last definition of the day, that is called depreciation. Now, see, whenever you will buy any kind of non-current asset, for example, you have bought a car today of $10,000. Okay. Do you think after a year or 2 years down the line, you will be able to sell it in $10,000 only? The answer is no. Maybe there is a wear and tear in the car. There are some scratches. You have used it. It will become the second-hand car. You will be able to sell it somewhere around $5,000 or $6,000, right? So there will be a decline in the value of asset as the time passes. Okay, and then that reduction in the value of asset is called what? Depreciation in accounting language. So we can write like, depreciation is an estimated loss in value of non-current assets. Over its expected working life. Simple. So these are some basic terminologies which I wanted to discuss. I will not say these are the only terms we will use in accounting. There are many more terms also which we will use, and I will discuss it with the respective chapters wherever it is being used. Okay, but before starting primary section of the subject, you need to understand these basic terms. So today we have discussed, if I'll summarize accounting, financial transactions, types of financial transactions, capital, drawings, liabilities, types of liabilities, assets, types of assets, receipts, types of receipts, expenses, purchases, next purchase return, sales, inventory, goods, trade receivables, trade payables, books of prime entry, and depreciation. So that's all for the day. I'll see you in the, let me stop sharing my screen. So finally, that's all for the day. I'll see you in the next video, which will be there on next Sunday. Okay, revise the things, be regular in the class. And if you will have any doubt, you can connect me on Telegram channel. Okay, also you can do WhatsApp to me. I will put the link and in the description box. You can go there and click on the link. You can connect me anytime. You can send me the email also. Stay tuned. If you will like my video, stay tuned, stay connected, subscribe my channel, put the bell icon on, and thank you so much. Bye-bye. Have a great day.